Not good lighting. Let me get it's turned off here. There we go. That's a little better. That. And let me get some light in the front here. Still not very good. I'll sit in front of the window to help the lighting a little bit there. Okay, here we go, guys. So today I want to do a real quick video. I mean, I say real quick, it's probably going to be like 5 minutes, roughly, about COH stock and I guess just the business and everything. Full disclosure, I am a small shareholder in COH stock. And I bought in January, and I would say I'm up a very, very slight amount. I think I bought in down around $32 or so. So I am up, a little over 10% on it. As it trades today at around $36.50. So, like I said, basically, I wanted to go through kind of the technical analysis that I've done on it, as well as just I've read through their SEC 10Q from the last quarter, as well as just done a pretty extensive review of where they're at financially, and also the bigger thing to me is how they're starting to function again corporately. So. Like I said, so the stock basically hit its low of the last year in September of 2015, and it was down around, I believe, $26, 27 and a quarter or so. With that, man, I gotta get this right. There we go. Let me try that. Get my thumb out of the way. So it got down to 27 and a quarter roughly over the last year. Which is, the lowest it's been really in 5 years. So, I mean, it's basically hitting its all-time lows here, with the exception of back in the crash of 08, 09, where it's seen its last big uptrend. The important thing that I'm seeing with COH right now, though, is partially their technicals. Obviously, I'm a technical / fundamental analyst when I look at stocks that I want to purchase. One of the big things I look at is the stock trading above its 20-day moving average, and is the 50-day ahead of the 200-day, so that way you can see a nice uptrend coming as the 200-day starts to catch the 50-day and that sort of thing. So that's kind of the technical side of it. Like I said, it crossed over, the 50 crossed the 200 back in January, so that's when I got in. Obviously it's been holding above the 20-day as well. So past that, now if you look at the fundamentals, so they had last year they purchased Stuart Weitzman shoes, which is going to be a very good purchase for them, I think. COH has been in the shoe game before, but Stuart Weitzman, it's a little bit different stuff. They're going to have a nice growth model there with Stuart Weitzman, as I believe, as they start to push that business a little stronger. They're going to have the ability to kind of to differentiate themselves, to show multiple brands that are successful. So Stuart Weitzman obviously has been a very successful shoe company for years. So with that, then the COH side of it, so that helped their growth this last year. And their North American sales were down, and their international sales were up. So North American sales were down, and on some point that kind of shocked me. But on the other side of it, I kind of look at it is COH had kind of gotten to a point where they'd kind of fallen out of the luxury game. So their stock was they were no longer selling bags that would be considered on the high-end luxury. Think Louis Vuitton, Prada. They kind of got down to the point where they were selling a lot of bags for the 198 range, 168 range, and I kind of look at that as that's a tough spot for a luxury brand if you're going to brand yourself as a luxury brand, I find that $200 price point and under is a tough spot to be successful. Basically, when I look at them, I'm thinking, well, who buys, so as a middle class family, if you're, as a husband, if my wife wants a new bag, I get her a bag. And if I spend $200 on a bag, guess what? That's probably the only bag that she's going to get. Now, versus the luxury side of it, where, most family, the wealthier families, if their wife wants a bag or, somebody wants a bag, they just go out and buy it because they've got the extra money. And so I kind of feel like that $200 price point is tough. It's a good spot for the middle class, but you're really only going to sell one bag a year. If you, stay in that higher end, you could potentially sell multiple bags to the same person, over a year. So that's kind of why I think that they probably lost some of their North American sales. On top of the fact they've been closing some stores and changing some stores around, but international's still been strong. So obviously they're still being viewed in the international, especially, in the Eastern countries, China, et cetera, that, they still have a strong brand loyalty there. So that's kind of where I see them at, now that they've started to put their purse, the bags back up in the $600 range. I think that they're going to, start to really bring that higher end, purchaser back in to their business. So, obviously they're a very trendy brand as well. So, as long as they can react to the trend changes, I think that it's going to be successful. And one of the big things that I've seen recently in trends is the desire to get the name, the big, huge name off of everything, and be a little more subtle. And I think that, they've reacted to that pretty well. So then the other part, so as an investor in Coach, one of the big things that I'm interested in, excited about, is the fact that they pay almost a 4% dividend. So this is still a company that's, still growing. I mean, obviously their PE's at 27 times earnings. So, they've definitely, and they've started to grow now with the Stuart Weitzman purchase, the international, the change in their own business. I think that this is a growth company still with a 27% P or 27 times PE, but for them to be paying a 4% dividend gives me a nice opportunity to buy in and just kind of wait, hold, see what happens over the next 6 months to a year, and if the stock holds well, then getting paid 4% to wait to see where it goes is going to be pretty beneficial, especially in this marketplace where the most you can get for or what you're basically going to get for a 3-month treasury is 1.5 points or 1.5%. So they are paying you to wait. They got a strong balance sheet. They did take out the loan last year, or the bond, at 4.25%. So it's not even like they have a high cost of capital there, and that goes out to 2025. So they're not going to have any problem paying that. And like I said, financially they sit with a nice, strong balance sheet. A lot of the hedge funds, a lot of the big institutional investors are invested in this stock. So I think that you got a good opportunity if you bought in. I probably wouldn't want to get in much more than 3.5% yield. So maybe right around this $38 would be kind of the max that I'd want to go if I was buying. But if you're already in and you've been in, obviously you've rode it down. Just in the last year you would have lost. It would have went from $44 or so down to at 27. So that was 17 out of 44. You're basically 35% loss or so. But if you're buying in now, if you're reinvesting the dividends, I think that this is a good long-term play. So if you guys have any stocks that you want me to take a look at, that you'd like me to do a little video on, give some advice, send me an email at mealickinvesting@gmail.com. That's mealickinvesting@gmail.com. Or you can find me on Twitter at cmealic, or on Facebook if you just search for Chris Mealic, and you can follow some of the different stuff that I talk about. So thanks, guys, and have a good rest of your Tuesday.